Good morning. Today is July 8th, 2025. Let's walk through the global financial markets for the past 24 hours. Global financial markets saw a sharp downturn on July 7th, 2025, mainly due to renewed U.S. tariff threats and rising geopolitical uncertainty. U.S. stocks reversed recent gains, bond yields rose, and the dollar strengthened as investors sought safety. Commodities were mixed. Agricultural grains fell sharply, while crude oil was initially resilient but softened later. Central banks are now diverging in their policy responses, reflecting different domestic conditions and the impact of global trade tensions. The main driver was the U.S. threatening new tariffs against major partners like Japan, South Korea, and a bloc of emerging economies ahead of a July 9th deadline. Additionally, a major electric vehicle CEO's announcement to form a new political party led to a sharp drop in that company's shares, adding company-specific risk. Volatility is expected to remain high as investors await clarity on trade negotiations and central bank responses. The interplay between trade policy, inflation concerns, and diverging monetary strategies will shape market direction in the near term. On July 7th, all major U.S. stock indices fell, erasing gains from the previous week. The index tracking smaller companies dropped the most, and all sectors ended in the red. This broad decline followed record highs in the main and tech indices, which had been boosted by a strong July 3rd jobs report and AI enthusiasm. The market's focus has shifted from positive economic data to external risks, especially trade policy. Smaller, domestically focused companies were hit hardest, as they are more vulnerable to tariffs and less able to absorb higher import costs. Asian markets also fell, with Japan and South Korea's indices dropping due to their export dependence and direct exposure to new U.S. tariffs effective August 1st. However, India's market bucked the trend, closing higher on July 8th thanks to optimism about a potential U.S.-India trade deal and late buying in banking and tech shares. This shows that while global trade tensions create a risk-off mood, local factors and diplomatic signals can drive resilience in specific markets. European markets were mixed. Germany's main index declined, reflecting its export-heavy economy's sensitivity to tariffs, while other European indices were flat or slightly positive. The European Central Bank's recent rate cut provided some support, but trade uncertainty outweighed the benefits of monetary easing. This highlights the struggle between supportive policy and external headwinds. The electric vehicle company mentioned earlier saw its shares tumble to a one-month low after the CEO's political announcement and the loss of a key tax credit. This shows how executive actions and policy changes can amplify market downturns. Large tech stocks also fell, though one major online retailer closed slightly higher. Chip stocks dropped, while a data analytics company led tech advancers. A solar company lost ground due to the phase-out of federal tax credits, and a medical device maker fell after naming a new CEO. In contrast, a retail company and food delivery company outperformed, with analysts citing strong earnings prospects and growth in grocery and mobility segments. Indian wind and tech stocks were also highlighted as top picks. This pattern shows investors favoring companies with stable demand or strong growth drivers amid macro uncertainty. U.S. government bond yields rose, with the 10-year yield hitting a two-week high despite falling equities, a rare scenario. This suggests investors are more worried about inflation from tariffs and increased government borrowing than about seeking safety. The strong July 3rd jobs report also reduced expectations for a near-term rate cut, pushing yields higher. The steepening yield curve reflects inflation concerns and higher expected government debt supply. Recent U.S. government bill auctions saw strong demand from international and institutional investors, indicating a continued appetite for safe, short-duration assets. High rates on these bills reflect the current interest rate environment and investor preference for liquidity amid uncertainty. Municipal bonds outperformed treasuries during the holiday week, with yields on top-rated munis falling. Limited new supply and strong demand, especially for tax-exempt income, drove this outperformance. The upcoming week is expected to see a rebound in new municipal bond issuance. The U.S. dollar index rebounded after hitting a multi-year low, supported by trade tensions, strong jobs data, and higher short-term yields. The dollar's strength highlights its safe haven status and the appeal of U.S. assets amid global uncertainty. The euro remained weak due to trade tensions and a dovish European central bank, while the New Zealand dollar fell on risk-off flows and policy divergence. The U.S. dollar also gained against the Canadian dollar, supported by weaker oil prices. The dollar dipped against the yen, which had rallied on wage hike demands in Japan. Overall, currency moves reflected central bank policy divergence and sensitivity to trade and commodity trends. Gold fell, pressured by profit-taking and a stronger dollar, despite some safe haven demand. China's central bank continued buying gold, providing a long-term price floor. Silver remained subdued, weighed down by high yields and a firm dollar. Crude oil prices rose initially but softened after a major oil group announced a larger-than-expected output hike, and U.S. inventories increased. Oil markets are balancing supply increases against demand concerns from trade tensions. Agricultural commodities like soybeans, corn, and wheat fell sharply due to China diversifying suppliers, increased competition from Brazil, and favorable U.S. weather. Trade uncertainty and ample supply combined to drive prices lower. In summary, global markets are being driven by U.S. trade policy uncertainty, diverging central bank actions, and shifting investor sentiment. While some sectors and regions show resilience, the overall environment is marked by heightened volatility, inflation concerns, and a flight to perceived quality and safety. The coming days will hinge on developments in trade negotiations and central bank responses. Thanks for watching, and we'll check in later.